I know there's a lot of free tools out there, but I found one tool that is really very powerful in basically being able to scan the entire market, find the best options that are giving really attractive premiums, and then those are the ones I focus on. In this video, I'm actually going to be talking today about options trading. I am by no means an expert in options trading. I'm still a little bit of a beginner myself, but I have had a few of my friends ask me about options trading, so I wanted to actually record a video and just share what little bit I know with them via this video, and then of course you, the viewer, who's watching. So this is going to be a little bit of a beginner video, so if you are kind of advanced in options trading, this may not be the video for you. I do use a few tools which you might be interested in, so you may want to just fast forward to that part of the video. Otherwise, I'm going to talk about what options trading strategies I follow. They are relatively conservative, and some of the tools I use, and even why you'd even want to do options trading in the first place. So if that's what you're interested in, then stick around and I'll show you what I'm doing. So the sector that I trade options in is the energy sector, specifically uranium, offshore oil services. These are the two sectors I know the best. I do run a website called Uneducated Investor. I'll have a link to that down in the description below. But I do write about uranium, I do write about offshore oil, coal. These are the sectors that actually tend to be what I know the best, and also do have a lot of interesting option strategies in terms of premium that you'll receive selling an option. There are two types of options that I sell. When I sell an option, I receive a payment, a premium, and I receive that payment instantly. I don't have to wait till the end of the option to receive that payment. You get, whenever you sell an option, you get that premium up front. And when you sell an option, what you're actually doing is you are selling somebody a right, but not an obligation. So when you sell an option, that person on the other end has the right to exercise that option, but you as the seller don't have the right to force them to exercise it. There is some risk involved. This is not a risk-free trade. You should understand what you're doing. So I do need to mention that up front. I'm not a financial advisor. This is not financial advice. When you're doing options trading, it's important in actually any type of investment, not just options trading. Stick with what you know. I'm going to show you in this video what I'm doing with regards to energy stocks. You should stick with what you know. Everyone should stick with the wheelhouse that they understand, and they'll do okay. So don't try and copy everything that I'm doing here. Exactly, it's about learning the technique, learning about the tools, learning about the strategies, and then applying it to whatever you know best. I've put together a beginner's guide to options trading. I will have this on my website as well. So if you want to refer back to this, you can take a look at the article. But I'm just going to go through it very quickly here for you for your crash course in options trading. An option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset, like a stock, at a predetermined price, that's the strike price, by a specific date, that's the expiration date. So every options contract has a strike price and an expiration date. And if the holder of that options contract does not exercise the options contract by the expiration date, then that contract expires worthless. So in return for this right, they have to pay a premium to the seller of the contract. An easy way to think of this is that when you are buying an option, think of it like you're buying a coupon, and that coupon is allowing you to buy something. It could be anything. In this case, we're talking about stocks at a fixed price by a specific date. And now when you have that coupon, it's up to you. You can choose to use that coupon or not. But if you choose to use the coupon, then the seller has to honor that price. So in the same way, when you are holding a options contract, you have the right to use it, but you're not forced to use it. If you don't want to use it, you don't have to. But if you do, then the seller has to honor the strike price that's agreed upon in that contract. There are two main types of options, a call option and a put option. A call option gives the buyer the right to buy the underlying stock at the agreed upon strike price. while a put option gives the buyer the right to sell the underlying stock at the strike price. So one way that I found that helps me remember this, when you have a call option, it gives the buyer the right to call away the stock from the seller at the strike price. And if a buyer is holding a put option, it gives them the right to put their stock into the seller's portfolio. Each options contract represents 100 shares of the underlying stock. Options can be classified as in the money, out of the money, or at the money. When you want to do any type of options trading, it is minimum 100 shares. So if you have 99 shares, you cannot sell a options contract. You need to have at least 100. Now, one thing that becomes a bit obvious here is that if you wanted to do options trading of expensive stocks, like some of the tech stocks, then you would need a lot more money because you would need 100 times whatever the share value is. Whereas if you try and pick stocks that are cheaper, maybe $20 or under, then 20 times 100 is certainly much cheaper than 2,000 times 100. So some of these tech stocks which have higher stock prices, you would need a lot more money in order to participate in that options game. There are many strategies that one can employ. I stick to two of the most basic types of options. I sell covered calls and I sell cash secured puts. For the rest of this video, I'm only going to be focusing on selling options for income. So I'm not going to be talking about buying any type of option. It's all going to be focused on selling options to collect a premium. So in the money means that the strike price of the options contract is below the current stock price when talking about call options. So for example, you sell a covered call with a strike price of $50 when the current stock price is $55. Now, why is this called in the money? Well, if the current stock price is 55 and you have agreed to sell your stock at $50 on a particular date, then you're selling your stock below the current market price, which means that for the buyer of this option, they are already in a profit technically when they buy this option. Now, is a theoretical profit because obviously a lot can happen between now and whatever the expiration date of the options contract. But for the purposes of this example, if you are selling somebody the right to buy a stock from you and you are offering it at a price that's lower than the current market price, then it's called in the money. In the money for the buyer of the option. For a put option, then the reverse would be true. In a put option example, the strike price of the options contract would be above the current stock price. So, for example, if the current market price was $50 and you agreed to sell a cash secured put with a strike price of 55, well, what that means is that you're agreeing to buy this stock at $55 when the actual current market price is $50. So again, for whoever is buying this option, there is a potential profit already when this contract has been sold. Now, again, a lot can happen between now and the expiration date, but that's why this is called in the money. Out of the money, if you can imagine now, would be the opposite. This would be a situation in terms of a call option where the strike price of the options contract is above the current stock price. So if you sell a covered call with a strike price of $60 when the current stock price is 55, what that means is that the current market price is $55, but you're agreeing to sell it to somebody on the expiration date at $60. Well, technically, your price is more expensive than the current market price. So whoever's holding that contract today, when they buy it, would be in a loss. So that's why it's called out of the money. And for a put option, the strike price of the options contract is below the stock price. So in this example, if you sell a cash secured put with a strike price of $45 when the current stock price is $50, then again, what does that mean? You've agreed to buy this stock from somebody at $45 when if they sold it in the market today, they would get $50. So at the moment, this option is considered out of the money. So that's the terminology that's being used here. At the money simply means that the strike price is equal to the current stock price. So if it's a covered call with the stock price of $50 and your strike price is $50, then that's at the money. Same for a put. If you are selling a cash secured put and the strike price is $50 and so is the market price, then that is considered at the money. I follow a two portfolio strategy when it comes to trading uranium stocks for income. And that's what I just wanted to go into here. And I just wanted to explain that the core of this approach lies in maintaining two distinct portfolios. A long-term portfolio, which is my core portfolio, my larger portfolio, and that one's for capital gains. And the options trading portfolio, that's for generating monthly income. Most of the stocks that are in my options trading portfolio are also in my long-term portfolio. And that's something important that I want to bring up later on. In my long-term portfolio, that's my buy and hold portfolio, I invest in uranium stocks with what I believe have strong long-term potential and which I plan to hold for a few years, allowing my investments to grow over time. This is my core portfolio, like I said, and this is designed to benefit from capital gains. And then I have a smaller portfolio. Now that's my options trading portfolio. This one is specifically for income generation. This is a smaller account, and this is dedicated to selling the covered calls and the cash secured puts. And this is to generate monthly income. I don't get fussed in this account that much. I don't get fussed if stocks in this portfolio get called away. Even if I like the stock, I may love a stock and I want to hold the stock, but I don't get fussed if this stock gets called away from this portfolio due to a rising price, for example, if I sold a covered call. And the reason I don't get fussed is because I hold this stock in my core portfolio. So even if I have this stock called away and I watch as this stock soars in price, I don't feel bad because I hold this stock as well in my core portfolio. And obviously my holding there is increasing in value. And if that happens where it gets called away and then I get cash then put into my account, then all I do is I simply start selling puts until I get assigned that stock back. So the purpose of the options trading portfolio is simply just to have cash flow coming in. And it's doing that by constantly having calls being sold and then getting called away eventually. That's going to happen. And then selling puts and eventually getting assigned as well. So there might be months where I see a lot of activity coming in and out where I'm constantly getting called away or assigned. But that's okay. That just means I'm collecting more premium along the way. I do aim to maintain a balance between stocks and cash in my portfolio, typically holding about 70% in stocks for covered calls and 30% in cash for cash secured puts. This allocation allows me to take advantage of both rising and falling markets. The reason for the 70-30 split is that generally I'm bullish, but if you, for example, had more of a neutral stance, you might go 50-50. And if you were bearish, then you might even go maybe something like 30-70, where you're only 30% in stocks and the rest you're holding cash and you're selling cash secured puts. The strategy that you employ, well, that's 100% up to you. And while this, of course, doesn't let you max out your portfolio at any given time, what it does allow is it gives you some room. If the market changes direction, at least you have some cash or you have some stock that you can then put into play to generate some premium. So just to recap, if you are talking about a call option, well, that gives the holder of the call option the right to buy the underlying stock at the strike price, while a put option gives the holder the right to sell the stock at the strike price. If your covered call option is exercised, you'll have to sell your shares. This is not optional. You'll have to sell your shares at the strike price. Remember, it's only optional for the holder of the contract, whether they want to exercise this contract or not. But if it is exercised and you've sold this contract, then you do have to follow through on it. And if you have a cash secured put that is exercised, well, then you have to buy that stock at the agreed upon strike price. You can't back out of that. You have to fulfill on this contract. You always want to make sure that you have the ability to buy. That's the only reason I sell puts in a cash secured way. I don't do any type of naked option strategy. A naked option strategy basically means that if you were to sell a call option without actually holding the underlying stock, or if you were to sell a put option without holding the cash ready to buy that stock, well, then you're putting a bit of a risk factor, even more of a risk factor into your portfolio, because should that contract be exercised and you don't have the ability to fulfill on that contract, whether it's a buy or a sell, then your account will be in a bit of a margin call, won't it? So 100% I advise to avoid that unless you really know what you're doing. And I'm assuming if you're watching this video and you're a beginner, you don't know what you're doing. So do not do any type of naked options trading. I really want to get into the tools I'm using that help me discover options contracts very quickly, very easily. I know there's a lot of free tools out there, but I found one tool that is really very powerful in basically being able to scan the entire market, find the best options that are giving really attractive premiums, and then those are the ones I focus on. Saves me a ton of man hours every day and every week in having to search for these manually myself. Let the software do it for me, and then I just go and I put in the trades that I want. If you want to see more of that options trading tool along with some examples to see how much you can actually make, then check out my next video. I'll see you there.